Good evening. I'm Richard Kapsch again, Managing Director of Pride Holdings in Schaumburg, Illinois, talking to you from Schaumburg. The 8th session we've got one more next week in which we're going to cover futures contracts that didn't record the last time. So next Wednesday or next Thursday, we'll have one more of these sessions. Today, however, we're going to switch our focus a little bit and switch from the focus on trading to one on investing. Trading has a short-term horizon, and that's what we've been mostly concentrating on before. Investing has a longer-term time frame. And specifically today, what we're going to talk about is investing in securities. And we're going to cover two areas. One is what we call the investment environment, and the second is the process of buying and selling securities. Okay, the investment environment consists of two components. One, identifying the kinds of marketable securities that are available for investment, and second, determining where these marketable securities are bought and sold. And then there's a second component to the investment environment, and that's what we call the investment process. And that's understanding how investment decisions are made, how extensive those investments should be, and finally the timing of them. When should they be made? Today or sometime in the future? So we're going to look at these things in a little more detail. First, we need to define what an investment is. An investment is sacrificing current dollars for future dollars. Okay, and it involves two factors. One is the time between the time you sacrifice those current dollars and you receive the future dollars, and the risk that goes with that those future dollars may go down in value between the time you invest and the time you actually realize the profits from your investment. So we've got an investment is sacrificing current dollars for future dollars, and it involves time and risk. And remember, as when we talked about risk and return back in week 3, the greater the time of the investment, the greater the risk that's involved. And the investor, when he invests, has to make sure he compensates himself for this risk that's associated with time. If anybody has any questions, just jump in. Okay, since we're talking about investing in securities, we also need to define what securities are. Their definition: a security is a legal representation of the right to receive prospective future benefits under stated conditions. Notice the difference between the trading instruments we've been talking about and the more formal definition of a security. Okay. When you enter into a security or invest in a security, you're actually entering into a more formal contract than anything we've talked about up till now. Okay, as with trading investments or any trade, as with trades, any investment we make, we're interested in calculating the rate of return, which we also went over in week 3. Excuse me a second. And the rate of return is calculated as P1 minus P0 divided by P0, where P1, where R is the rate of return, P0 is the beginning price, the price at which we make that investment, and P1 is the ending price, the price at which we sell the investment. So that's simply a review of what we did in week 3. So in investing, we're really interested in estimating the rate of return that we're going to get from this particular investment. Remember, that rate of return has to compensate us for the risks that we associate with that investment. Okay, there are 3 major types of securities that we'd be interested in as an investor. First is treasury bills, and these are instruments or pieces of paper that are issued by governments with a trading horizon of less than 1 year. So a treasury bill is basically a piece of paper that says we're going to receive some amount of money at the end of some time frame, and that time frame is less than 1 year. Usually these are sold on a discount basis. So if a T-bill is worth $1 million with a face value of $1 million, we would buy it at some discount to that and be paid $1 million at the end of the time period. Okay, a second form of security, which are lumped together, are long-term bonds and notes. These are also agreements, usually from governments, but can also be from corporations, in which they agree to pay you back some amount of money at the end of the term, and in the interim they also make interest payments. So an investor investing in long-term bonds and notes would be interested in getting his principal returned at the end of the period, but between the time of investment and the time of the maturity on this instrument, he gets paid interest payments. And the difference between bonds and notes generally have a maturity of between 1 year and 10 years. Bonds are generally over 10 years. Okay. And then the third type of security, the one that we're going to be discussing today, is common stocks. And common stock represents a piece of paper representing ownership in a particular company. And that's when you have ownership in a company, that means you have the right to share in any profits that that company makes. Okay, now the stocks may or may not carry voting rights with it. If it carries voting rights, not only do you get to share in the ownership of the profits down the line, you also you have your say in how the company is run. Stocks that don't have voting rights, you don't have this ability to influence the management of the company. Everybody with me so far?
Yes, sir.
Okay. Okay, these securities that we're talking about, and again, we're going to be talking about mostly stocks from this point on, are traded on what we call security markets, as opposed to commodity markets or over-the-counter exchanges or anything. These are traded on security markets. And the primary function of a security market is to provide a meeting place for buyers and sellers. Now, this can be a physical location, like the floor of the New York Stock Exchange, where buyers and sellers get together and buy and sell stock, or it can be an electronic meeting place, which is the direction we're generally moving in today. So you have to buy and sell securities on a security market, which place for buyers and sellers to get together. Now, there are two types of primary markets based on the issuer. The first is what we call a primary market, and this is the market where a company goes to raise money for its operations when it sells stock initially. Okay, and we associate primary markets with initial public offerings, IPOs. When a company initially goes out to raise money, the money that's raised from selling these shares of stock on the primary market goes to run the company's operations. Okay, now once the company is traded, after it's sold on the primary market, we say the stock has gone public and it's available for trading by the general public. Once the stock goes public, it's then traded on a secondary market where buyers and sellers meet and buy and sell those stocks that are available for trading in the general marketplace. The secondary market is generally where any of us that are interested in investing in securities are probably going to be trading or investing. Okay, in addition to the investment environment, or I should say that the availability to buy and sell securities, the second aspect of the investment environment is what we call the investment process. And this is a process that every investor should go through in terms of making investments. In other words, when you're a trader, you look for trading opportunity. Your time frame is usually short. You're hoping to make a quick profit. And your main goal is simply trading profits. When you're an investor, the process gets a little bit more formal because we're talking about larger sums of money and longer time frames involved. And this is a process that's carried out by every investor, whether it's an individual such as you might be, or an institution like a mutual fund or anything else. All of these investors generally follow the same process, which we call the investment process. And as you can see, there are 5 steps involved. One is to set investment policy. Second is, once you've set your investment policy, to perform security analysis. And we'll talk about these in greater detail in a minute. The third is, once you perform security analysis, you put together a portfolio of your investments. And then once you've put the portfolio together, you don't put it in a drawer and walk away. You've got to constantly revisit it and revise the portfolio. And then at certain points of time, you're evaluating the performance of the portfolio. So it becomes an active involvement on the part of the investor. Okay, step 1, we said, was set investment policy. This is very important for every investor to do. First thing you do is you want to identify what your unique objective is. Are you in it for long-term investments? Do you have goals down the road that you want to realize certain returns and use that money for those returns? Or do you have a somewhat shorter term objective? So every investor has his own unique objective. Once you've determined what your objective is, then determine the amount of investable wealth. How much money can you commit to any particular investment in the security? Once you determine the amount of investable wealth, you want to go back to these objectives and specific objectives in terms of risk and return. How much risk are these investments going to involve? Once you've determined what the estimated risk will be, you've got to plan an investment so that you generate enough return to compensate you for the risk you're taking on. And then finally, once we've set these investment objectives, we look at potential investment categories. Okay, do we put all our money in common stocks, or do we put some of it in fixed income securities like treasury bills or treasury bonds and notes or corporate bonds? And then once we've made that decision, we also want to look at the common securities, and we want to identify which sectors of the market we want to invest in. Do we want to put all our money in, let's say, oil stocks, or do we want some more diversification? So the investment policy is extremely important for any investor setting out on investing in securities. Okay, the second step in the investment process is what we call security analysis. And this is really a form of fundamental analysis. We talked in forecasting prices back then. But now, instead of looking at macroeconomic factors, really looking at the specific factors that affect the operation of any particular company we're interested in investing in. Okay, so the first step in security analysis, using these investment categories that we've identified, we want to find something called mispriced securities. Okay, now what are mispriced securities? You might get an argument if you've, let's say, been in college and taken an investment course that all securities are priced accurately, but in reality there are mispriced securities. By mispriced securities, what we want to do is use our fundamental analysis and determine the intrinsic value of the stock and compare it to the value we get from fundamental analysis using discounted present value. We take into account all these factors affecting the outcome of the company, and we make an estimate of where the stock should be. And then what we do is, once we make this estimate, we then compare the current market price to what we think is the true market value. So this is the important step. We want to compare where the stock is trading in the market to what we consider to be the real market value of that security. And then what we want to do is identify undervalued securities. These would be securities where the current market price is well below or somewhat below the value of the price at which it's trading in the market. And this we would consider to be an undervalued securities. Now this is the process that Warren Buffett goes through in his investment. He's probably the most famous, or one of the most famous investors in the world, and he's been extremely successful over a long period of time. And his main goal is to look for these undervalued securities. And once he buys them, then the idea being is that once you've identified these securities, you purchase them and you hold on to them in the conviction that ultimately their price is going to rise in the market and equal what you consider the true market value to be. So security analysis is really, we're looking at mispriced securities. We want to buy those securities that are where the current trading price is below what we consider its true value to be. Everybody understand that so far?
Yes, sir.
Okay. Okay, once we've identified these mispriced securities, we want to start to put together a portfolio of securities. And that first step in this, or the first sub-step in this step, is to identify specific assets and how much of our investable wealth we want to invest in each specific asset. So this is what we call security allocation. We want to allocate our wealth among various stocks in the marketplace. And in so doing, there are three issues we want to address. One is selectivity, in other words, which specific stocks are we interested in? Second is timing, just like any other trade. We want to, is this the right time to buy these things, or do we think that perhaps the stocks are going to get cheaper and we can buy them later? And finally, we want to consider how much we want to diversify our investments. In other words, you never want to put all your eggs in one basket. You want to put them in several different baskets so that if one stock goes down, the whole portfolio doesn't collapse. So the three issues we want to address in constructing a portfolio are the issues of selectivity, selecting which specific stocks to invest in, timing, when to buy them, and diversification. How different are their operations from each other? Okay, now we've gotten to the point where we've set up our portfolio, we purchased the stocks. Now what do we do with them? Do we sit back and just wait for the money to come rolling in? Or is there something else we have to do at this point? The answer is investing in securities is really an active process, or an interactive process, where we've got to consistently look at this specific portfolio and determine what to do with it in the future. So step 4 is the step we call portfolio revision. And this is periodically repeating step 3. Step 3, where we've identified the proportion of wealth in which issue to invest, which stocks we should buy, and how much diversification ever. We want to look at that step 3 and revise if necessary. First of all, we want to increase or decrease the existing securities that are in our portfolio. Are there some sectors that are outperforming others that we think are going to continue to outperform in the future? If so, we want to increase the portion of wealth put in those specific securities. If there are sectors that for some reason the fundamentals look negative, like perhaps something happens to oil stocks, and we want to decrease our shares in those securities. So step 3, in revising the portfolio, we want to delete some securities, or at least reduce our holdings in some securities. And we may want to add new securities in the process. So it's a continuous process that goes on and on and on, step 3 and step 4, where we decide which stocks to invest in. In step 4, do we want to stay in those particular stocks or change our portfolio? And finally, we've got step 5, which we call portfolio performance evaluation. And this is simply, we want to calculate how well our portfolio is doing at various stages in time. You don't have to do this on a daily basis, but if you're an investor in stocks, you should be doing this periodically, maybe on a monthly basis, to determine how is our performance relative to what our estimated risk is. And then, to do that, we've got to be able to measure that risk in return. So portfolio performance and valuation is something that we do periodically with our portfolio. We never sit back and just put it in the drawer and forget about it. We come back 2 years later and say, oh, hey, we made money, or hey, we lost a lot of money. It's something it's a very active process. Okay, now let's look at the process of buying and selling securities themselves. And we we buy and sell these securities in a market called the securities market, which we talked about before. And generally what you're going to do is go through a broker. Now, definition of a broker is an individual that acts as an agent for you as an investor and gets compensation for acting that way. In the past, brokers were generally compensated by commissions, just like if you're trading foreign exchange or something and you're dealing with a broker, he gets paid by commissions on the trade. And up until, let's say, the last 10 years, that was usually the primary way brokers were compensated in the securities market. But now firms are switching to being where brokers get compensated on a performance basis. In other words, how well are they doing for you as an investor, and then taking a percentage of whatever profits you make, or if there are no profits, perhaps getting no compensation. Most mutual funds operate on a performance basis where, instead of commissions, they'll take a small percentage of your assets and or a percentage of the profits you make in a particular investment. Okay, in the securities market, there are three major types of firms. First are what we call the institutional brokerage firms. These are firms that deal primarily with brokers themselves, with institutions themselves, such as hedge funds, mutual funds, these type. And they're in a class by themselves, and you probably won't be dealing with these type of firms unless you're running your own mutual fund. The second type of firm, and the one that you're primarily going to deal with, is a retail firm, and these are individual brokers that deal with individual customers, and they get compensated, as I said, either on commissions or percent of the profits that they generate for those customers. However, that compensation is based on the amount of services that they provide for you. If you go, for example, if you go in to a broker and you say, okay, I have $1 million, I want to invest in securities, tell me what to do. Depending on how much advice he gives you in terms of the investment process that we just talked about, and when and how to buy these things, the greater the compensation he's going to receive. Okay, so most of us in terms of investment are going to deal with retail brokers or retail brokerage firms. The third type of firm that's out there is what we call a discount firm. And these are firms that provide almost no or very little advice or assistance in trading. They determine that most of the decision making is going to be made by the customer, the investor himself, and they simply are available to execute trades that broker wants. So it's kind of a halfway between the institutional brokerage firm, which deals strictly with large institutions, and the retail brokerage firm, which provides a lot of service. The discount firm provides almost no service other than execution. And as we go forward in time, you'll see this dividing line between retail and discount is starting to disappear. Discount brokers are providing more and more services to the investor at very little additional cost, and the retail brokers are being forced to come down on their own compensation. So these are the three major types of firms that you would deal with in terms of buying and selling securities. Okay, now let's look at the mechanics of buying and selling securities, and we're going to see that there's a lot of similarity between the mechanics of buying and selling securities Excuse me a minute. Okay, securities are generally traded in two types of quantities, which we call order size. One are what we call round lots, and when we talked about stock options, we said that each stock option generally covered one round lot, or 100 shares of stock in that particular security. So generally, when you are trading securities, you're going to be trading in round lots and multiples of 100 shares of stock in that particular security. Occasionally, however, you may have to deal in what we call odd lots, and those are lots of less than 100 shares. For example, suppose you get a stock dividend and when it's set, sell it in the market. It may or may not be a multiple of 100 lots, so you may deal in what we call odd lots. Okay, when you're entering an order to buy or sell a security, just like when you're trading currencies or futures contracts, every order has a time limit, and that must be specified by the broker, but must be specified by the investor when he's ordering a particular buy or sell from the broker. Now, some typical time limits, or most orders are going to be day orders. If you put them in the morning and in their price order, they're going to be good until the market closes at the end of the day. You also might have good till canceled orders, GTC orders, which you might use for stop orders, and these are good until you specifically instruct the broker to cancel that order. Third are something we call fill or kill orders. These are orders that you put the order in on a fill or kill basis. He tries to buy it at a specific price. If he's unable, then the order is automatically canceled. Okay, the types of orders that we deal in are very similar to the orders that you deal with on a regular basis. You're trading futures or currencies. The most basic order is the market order, and this simply means when that order is put in, you fill it immediately at the best possible price, and it may be above or below. If it may be above if you're buying above the price it was trading at when you entered the order, or it may fall below the price if you're selling in the order, selling a security. But when you enter a market order, you're simply saying, I want it filled at the best possible price you can get at the specific moment in time. The second type of order in securities, just like currencies or futures, is what we call a limit order. And this is when you specify a specific price to buy or sell a security at. And it simply means that if the price moves above your limit price, you may not get executed, but they can't fill you above your limit price. Excuse me. And if it's a sell order, they can't sell it below your limit price. Just like in currencies and futures, there are stop orders, and the stop order is simply if it's a buy stop, that stop order is entered with a specific price, usually above market price, or no, below the market price, I'm sorry, buy stop. So if you're long a security and you want to limit your loss, you would enter a sell stop order below the market with a limit price. Once that price once that price falls to your limit price, that stop order becomes a market order, and you get filled at the best possible price. If you put a sell stop in, a buy stop is above the market and usually wants to limit your loss if you're short a particular security or you want to sell at no higher than a specific price. Again, once that order reaches that specific price, it becomes a market order. So the stop order specifies a price, but it only tells you when that price is touched. It triggers the buy stop as a buy market order or the sell stop as a sell market order. Okay, we also have stop limit orders, in which if you specify a price in conjunction with your stop order, but when you say it's a stop limit, that means that if it's a buy stop, it cannot be filled above your limit price. If it's a sell stop, it can't be filled below your limit price. The one drawback with stop limit orders are that there's a possibility it may go through your limit price and never come back to your price, and you may not get executed. So you got to be careful when you're using these particular orders. Okay, let's talk about margin accounts and securities. Okay, when you trade currencies or futures, generally these are considered to be margin accounts. And all that means is simply you put up a small fraction of the value of a contract in when you're trading these things. So as we talked about in, I think, week 3, when we talked about leverage, the advantage to having a margin account or a margin type of account in currencies or futures are simply that you get to make extraordinary returns, but you also have a lot of risk on the downside. Okay, a margin account in securities is somewhat different. In margin accounts, you're actually borrowing money on a line of credit for more money than is in the investor's cash account. So there are two ways to buy securities: through a cash account where you pay 100% of the price of the security, and a margin account where you borrow money from the broker to help you buy these securities. Most margin accounts are 50%, which means that they will loan you up to 50% of the stock's value and enable you to buy the thing. So you get leverage, but not the same kind of leverage that you get in currencies or futures. In this case, with a 50% leverage, with a 50% margin line, your leverage is really 2 to 1, where you get to invest $2 for every $1 that you put up. The difference is that these are actually more formal loan accounts than what your currency or futures account might be. So you're actually borrowing money from the broker to enable you to buy more stock than you could afford in a straight cash account. Now, when you open a securities account to trade and you're going to trade on margin, there are certain aspects of the margin account that are a little bit different than what you might experience in trading currencies or futures. Okay, the first thing that's going to happen is you're going to sign something called a hypothecation agreement with the brokerage firm. This is a formal contract or formal agreement that allows the brokerage firm that's lending you the money control over the stocks that are in your portfolio. It allows them to pledge those stocks against the loan, and it allows them to borrow money against those particular stocks. So a hypothecation agreement allows the firm itself to use your stocks as collateral in loans to yourself to generate this additional leverage. So it's a little more formal than a regular trading account that you're probably used to. The other thing that normally happens when you open a margin account, your stocks are carried in what we call street name. If you have a cash account, all those stocks are carried in your specific name. If you buy or sell stocks, or particularly buy stocks, they're going to be carried in your name. However, when you're opening a margin account, because it's a line of credit from the brokerage firm, that they have the right to keep those stocks in street name. And what this does is enables them to sell that stock out if you don't make a margin call, or they can do whatever they want with the stocks. It's like having a power of attorney over your particular stocks. So the advantage of a margin account is you have the ability to generate leverage or use leverage basically by borrowing more money than you have to invest. But there are a lot of restrictions that go along with it. The brokerage firm maintains more formal control over the stocks in your particular portfolio. Now, when you buy stocks on margin, you have to come up with an initial margin, which we said is really generally 50% of what the total stocks are worth. And the actual margin you pay is calculated by that formula, market value minus loan divided by market value. So you have to come up with an initial margin of 50% generally, and that enables you to buy stock on margin and use the leverage that it carries. Now, once you bought that stock, just like in currencies or futures, the brokerage firm calculates maintenance margins on your position. And again, this is a little bit more formal than the process is carried out in general trading. And the purpose of maintenance margins, as you might understand from your regular trading, is one, they're established to prevent default by the investor. The brokerage firm never wants you to get in their pocket. They want to make sure that there's always excess funds available in case your position goes against you. Second, once they've calculated the maintenance margin, the customer has a requirement to maintain their position at the maintenance level or above. And when it goes under margin, then they have to put in additional funds or to restore it to that level. Now, what happens when you're under margin in a stock account? That means simply your account value has fallen below the maintenance level, and you have to do something to restore it. There are three ways to do that. One, you can deposit more cash like you would in your trading account in currencies, or you can put additional securities into the account that they can use as collateral against that margin payment. Second, you can pay off part of the loan. Or 3, you could sell out some securities to sell enough securities to generate enough cash to help you meet your margin call. And by virtue of having signed a hypothecation agreement, when you open the margin account, all the control of that account falls with the brokerage firm. So you're basically at their mercy. If you fall below margin, they can really do whatever they want with your securities in that particular account. Now there's a bright side to being a margin account, and that's being over margin. If your account generates a profit and you rise above the maintenance margin, you can actually withdraw funds from the margin account. So margin account enables you to generate leverage, but control of that leverage is really lies with the broker. Okay, any questions on anything I've covered so far?
Sounds fine, sir.
Okay, got 2 more things I want to cover today, and one is CFDs, contracts for difference. There are CFDs available for trading in any particular financial instrument, and stocks are no different. So there are firms that issue contracts for different CFDs on individual stocks, and these CFDs trade just like individual stocks. The difference is when you buy a CFD, let's say on IBM, you're not getting ownership in the company, and you don't have that formal connection between you and the company in terms of stockholders. So basically, you're simply hoping that when you buy an IBM CFD, that the price of IBM appreciates, and when it goes down, you're going to lose it. But usually these firms are the firms that issue contracts for difference are not regular brokerage firms. They're special firms that deal in CFDs, and the margin on these are not traded like regular margin accounts, but rather like currencies or futures, where you put up a small percentage of the total value of the contract. The drawback on a CFD is you got to know who you're dealing with when you're dealing in that CFD, because you don't have the exchange or the Securities and Exchange Commission in the United States backing these particular stocks. In other words, you're simply betting on the financial wherewithal of the company that's issuing these CFDs. So they're considerably more risky than buying individual securities. Okay, the last topic I want to cover is something called high-frequency trades or high-frequency traders. And these are traders that have emerged in the last 10 years generally in the stock markets. And these trade 100% on computer algorithms. In other words, there's no human intervention in these things. They simply plug their algorithm, plug their computer into the marketplace, and buy or sell based on this algorithm. And generally they're looking for the same thing we looked at in trading currencies or futures. They're looking for trends, and they want to jump on those trends and ride them as much as they can, and then get out rather quickly. These high-frequency traders constitute the greatest bulk of stock trading. I would say probably 90% of all the shares that are traded in stock are traded by high-frequency traders, and they're extremely short-term. We're talking nanoseconds in some cases. So in terms of short-term trading, it's good for the high-frequency traders, but in terms of an investor who's investing in securities, they're at a big disadvantage, because there's no way you can compete with these high-frequency traders. So that's why I think the focus of anybody investing in the stock market should not be to try and look for trends on the short term or day trade, but really follow the process that we talked about in terms of a longer term investment horizon, where you look for mispriced securities that are priced below the market. You invest in them and you hold them for the long term, with the idea being that that price is ultimately going to generate a profit for yourself. It leaves the short-term trading to the HFT guys, the high-frequency traders. Okay, that's generally all I wanted to cover today. Is there any questions on anything I talked about?
I think so.
Nothing. Okay. Now remember, next Thursday we're going to redo the session on trading futures contracts. It'll be the same time on the 11th, and that'll be make up because we had technical problems the first time we tried to do that. So hopefully we'll talk to you next Thursday. Okay, thank you.